We've seen Telus stock as undervalued for a while now. The company has had its low points, like layoffs last year, but as we've seen lately, the Canadian communications sector is already prone to sending confusing signals. From epic service outages to tensions with regulators, investors have had a tough time tuning into what matters most for long-term growth among Canadian telco stocks. Sure, if you were to look at the bottom line, you'd find that Telus was leading the communications space in Canada in terms of recent results. They had the best revenue and earnings growth last quarter and added the most internet and wireless customers. But even those great results can be distracting. Investors might be missing out on distinguishing factors on the downside among Canadian telco stocks. Telus has fewer headwinds when it comes to wrapping up legacy businesses. Its growth isn't offset by a large wireline telephone business that it needs to wind down, and it has no legacy television customers to transition. And investors in the Canadian telecom space may be missing out on opportunities outside of the sector. Unlike its peers, Telus has also made substantial investments in businesses that are not typically related to telecom, according to senior equity analyst Matthew Dolgan. Businesses like Telus International, Telus Health, and agricultural services have high upside potential, and we predict growth rates in the double digits through to 2028. With Telus tapping into alternative revenue sources with higher return potential, there will be higher risks and a potential drag on margin. Meanwhile, with the bulk of capital spending complete for Telus, the company's free cash flow should rise significantly in the coming years, and just might be able to afford those riskier bets so Telus can become more than a telco. For Morningstar, I'm Andrew Willis.